Well, Citi has written a very interesting note as far as the Indian equity market is concerned. It's a strategy note that they have released. What they are taking into account is, number one, the budget. Number two, given the fact that we are midway and more than midway into the earnings season. Now, what is Citi saying? They said that so far in third quarter, earnings have handily beaten street expectations, and NIFTY earnings are up almost 26% on a year-on-year basis, which is almost 12% ahead of Citi estimates. The robust performance, according to them, has powered the strongest earnings upgrade momentum in over 10 years. Also, what they're saying is that continued strength in FII flows as well as a growth supportive budget have further boosted the market sentiment. Now, what they're saying is that there are risks to continued earnings momentum given the fact that there are input cost increases, a plateau as far as near-term recovery trends are concerned, and also what they're saying is that valuations leave little room at almost, given the fact that it is 2 standard deviations above the long-term averages. They've also recently incorporated the EPS upgrades, and they have raised the NIFTY target to 14,500, and this NIFTY target is based on 19 times FY22 EPS that they have taken into account. Now, what they are saying is that the earnings beat in the third quarter so far has been aided by better than expected operating margins. Top line, according to them, for their universe is slightly ahead of estimations, 2.5%, while operating profits are almost 8% ahead of estimates, while profits are 12% ahead. So clearly it's an operating performance, operating efficiencies that have come into the fore. Also, what they are saying is that costs are recovering slower compared to revenues, and there were beats across the sectors led by consumer discretionary, industrials, as well as healthcare. Now, what they are saying as far as the ownership of Indian equities is concerned, FI ownership of Indian equities rose quite sharply on a sequential basis, up almost 140 basis points, reversing the decline that was seen in the first half of FY20. Now, when you're talking about institutional investors, they reverted to large caps in the fourth quarter of FY20, given the fact that both sequentially, both FIs and DMS actually saw quite a bit of an increase as far as allocations is concerned. Now, when you're talking about the earnings growth momentum, according to them, earnings have maintained a strong upgrade momentum. NIFTY FY21, FY22 consensus EPS is up almost 13% and 10% respectively since October 2020. The budget has been supportive for growth, although execution is key according to Citi, and they would be watching for the impact as far as interest rates are concerned. Now, what have they done in their model portfolio? They've made a few changes. Their key overweights remain financials, industrials, telecoms. Their key underweight as well as real estate. Their key underweights are consumer as well as auto stocks. Only worry, according to Citi, is valuations. However, what they are saying is that valuations compared to earnings, and given the fact that such a good budget is coming, they believe that if execution is strong, they at this point of time continue to remain quite positive with slight tweaks to the model portfolio.